Happy Monday, everybody. I hope you had a good weekend. Overall, we're coming off a relatively quiet weekend for news. I say that nothing has happened, and that would not be accurate, of course, but let's stay focused. Overall, it was quiet until a little bit earlier today and late yesterday. But today is March 24th, 2025, and this is your Monday market update. I'll do the shameless plug at this time and say that as the markets are a bit volatile, to say the least, these Monday videos will focus in on what happened and why and what to expect in the coming week. It's a short check in, so please try to watch if you want to know. Last Monday, markets opened the week on a firmer footing as all three major indices rose at the open. The rebound followed last week's selling and was supported by mixed but not alarming economic data and a calm geopolitical backdrop. Markets were driven by a few notable news items. Retail sales started the parade, and February headline number missed, but the control group rose +1, suggesting resilient consumer spending. Again, note what is actually happening in this market. Algos, yes, headline missed, and the news stories ran with it. After all, the AI read it and had the story written, headlines, photos, and all within milliseconds. Did the AI even keep reading? I don't know, but not likely. That is why you see so much volatility. I think, I guess you'd call it jumping to conclusions. So now you know why it happens. Empire manufacturing surveys dropped sharply, raising fresh stagflation concerns, but the market largely brushed that off. As markets started to look ahead, investor attention began to shift forward to the Fed's March meeting starting on Tuesday. Overall, there were no new tariff escalations and modestly supportive data. Markets welcomed a pause in policy-related fear, fueling a relief rally. The Dow was up over 0.75%. The S&P was up almost 0.2%. And the Nasdaq was up a bit over 1/3%. Markets pulled back after a two-day rally from Friday and Monday, with all three indices down on Tuesday. The decline was largely driven by profit taking and positioning again ahead of the Fed's decision on Wednesday. Tariff tensions did resurface as the Wall Street Journal reported that the White House may introduce a new tiered tariff structure. Again, something new, reigniting trade war concerns. Hot inflation reads, the Canadian CPI and the U.S. import-export prices came in higher than expected. You know, I'm always poking fun at random inflation numbers, but I guess we should actually pay attention to the Canadian numbers, at least for now. February industrial production and manufacturing both top estimates with the notable 8.5% rise in auto production. Technically, the S&P 500 stabilized near that 5,600 level, which is a heavy option strike price, and avoided deeper losses late in the day. No new bad news was needed for the markets to fall. Uncertainty alone was enough to pull stocks back, especially headed into the Fed. The Dow was down 0.2%, S&P down over 1%, and the Nasdaq was down 1.5%. Fed Day Wednesday, and markets rallied late on dovish tilt from the Fed, with all three indices up on the day. Headline that moved the market, the FOMC decision. No change to rates as expected. The Fed's tone shifted slightly more dovish. There was focus on a few highlights. Risks to growth were emphasized over inflation. As you've heard me say here, I'm not worried about inflation at this time. I'm worried about growth and I'm worried about valuations. The Fed did announce that the balance sheet runoff was going to be slowed, reducing pressure on treasury markets. And the big news was that Powell reintroduced the term transitory and downplayed recent weak economic surveys, and boy, did the media run with that. I'm not sure there will not be a new Fed swag made with the new transitory quote. So we'll see what happens with that. There was some geopolitical calm as ongoing progress in the Russia-Ukraine ceasefire talks helped risk sentiment. Tariff talk, cabinet officials were reportedly working to avoid a reciprocal tariff wave before the April 2nd deadline. The takeaway from Fed Day, the Fed didn't promise immediate rate cuts, but it did confirm it's watching growth closely and is prepared to act if needed. Investors saw this as a reassurance that Fed put still exists, even if it's far from the money. So the Dow was up almost 1%, S&P up a bit over 1%, and the Nasdaq was up over 1.5%. Markets did chop sideways on Thursday. It seemed to be digestion day after Wednesday's strong post-Fed rally. Happens pretty often these days. Sanctions on Iran reignited geopolitical anxiety, and the White House reiterated its big tariff plans. Dovish flows persisted but failed to break markets to new highs as caution remained. The economic data is still strong. Jobless claims came in at 223,000, reinforcing labor market stability. The Philly Fed slowed but stayed in expansion territory. Markets could not build on the Fed-driven bounce as fresh earnings and geopolitical tensions reminded investors that multiple headwinds still remain. Friday opened lower on the back of some disappointing earnings from some pretty pivotal companies, Nike and FedEx. I mentioned these last week as ones to watch. They say a lot about growth and overall global growth, especially with the consumer. Recall, 70% of that U.S. economy is the consumer. Nike and FedEx both gave two major sources of concern, of course, tariffs and growth forecasts. They led the markets down. They led the fact that consumer stocks and transportation stocks were hitting 52-week lows. For all of you who thought that it was different this time and tech stocks could go up and up and up and never show weakness, think again. Well, the market will remind you all when you have to. Tech is the worst performing sector this week, fifth straight week of losses, first time since May of 2022, 14% below the high, and only one sector is worse, and that's consumer discretionary. That's down about 20% from its high. There was a lot of talk about the next catalyst being April 2nd, when certain tariffs are set to take effect. Do you really think it'll take that long before some catalyst comes along? Speaking of, how about the presidential quote? While we're figuring out how many hours until April 2nd, President Trump is saying that there, quote, may be some flexibility with tariffs, close quote. And that was all the markets needed. Off the lows of the day on Friday, too fragile and too much damage for that to set a rally in motion, but markets did finish in the green for the day. The Dow was up just under 0.1%, but green. S&P almost exactly the same, up and green, and the NASDAQ up about 0.5%. After all that, I had to fact check the reading, but I did over the weekend. But yes, markets closed in the green for the week, stopping the weekly losing streak for now at 4 weeks. The Dow was up 1.25% for the week. S&P up 0.5%. The NASDAQ was up 0.25%. It's hard to believe, but it's true. Let's see what this coming week is set to bring. I know you all know this by now, but the Fed's favorite inflation gauge, yes, you got it, the PCE. That's due out on Friday along with consumer sentiment, and that's going to make some noise. Before we get to the eco data on Friday, we'll go through some housing data. I still think that's going to be ignored. We will get two confidence readings this week, one tomorrow and one, as I mentioned, on Friday. That will be watched, but note, when confidence is low, it is often a contrarian indicator. One of my rules of the market, make a fool of the masses. So we'll see what happens there. We'll get high-frequency jobs data as usual. Watch for continuing claims, not just jobless claims. And on Thursday, we're going to get a spotlight of what we cannot seem to stop talking about, trade. We'll get advanced numbers on trade balance, retail and wholesale inventories. We'll get a few earnings, watch for consumer reads, and of course, no more Fed head blackout. So get your bingo cards ready. Bostic starts us off today. Barr, Williams, Kashkari, Musalam, Barkin, and then Bostic will close out the week as well. So that's the read on the days behind and the days ahead. I try to keep it clear and short so you can get a feel for what's going on. As always, we stay focused on the long-term goals, but remember, as I said on Friday, change brings opportunity and opportunity can bring growth. All as things change, uncovering new opportunities is what we try to do. For now, let's keep focusing on our risk profile, making sure that is correct. Two last points. One, if you turned 73 last year and deferred your first RMD, April 1st is your deadline and it's coming soon. And the same idea, April 15th is the last day to make your 2024 IRA and Roth IRA contributions. After that, you're stuck with just 2025 until next January. So please stay in touch if you have any questions or you want to review your risk. Have a great week. It is sure to bring some surprises. You never know.